Okay. Hello, everybody, and welcome to our webinar today on Axis Momentum NFO. Good evening and a warm welcome for the webinar. And for the same, we have with here Mr. Karthik Kumar. Brief introduction about Sir. Mr. Kumar is a seasoned investment professional with extensive experience in quantitative investing. He's currently leading the quantitative team at Axis AMC and manages several successful funds including Axis Quant Fund, Axis Arbitrage Fund, and the new Axis Momentum Fund. With his deep understanding of market trends and his proven track record, Sir is a perfect person to shed light on this exciting new fund offering. Welcome, Sir. We are so happy to have you. Before
Thanks
I
for the
hand over
introduction.
the
And
stage to you,
yeah, no, please go ahead.
yeah. Um, before before I hand it over to Sir, I would just like to make a few things clear that we would be taking up questions towards the end of the webinar. So you can drop off all your questions or queries in the comment section, and we would be taking those up after Sir is done with his talk. Sir, over to you. You can take over.
Thanks a lot for that introduction, and thanks for having me here. So what I'll do is I will cover two aspects. One is what is momentum, and how are we at Axis going to manage momentum? What is going to be special in the way we look at momentum? So, firstly, to understand what is momentum, we thought it is best to start with the cricketing analogy because it's something we all relate to. So let's say you have a batsman who's done extremely well for the last three series, right? And the batsman comes on to bat. We all are confident that the batsman is likely to do well because over the last three, four series, he's been doing extremely well. And similarly, if a batsman has gone through a terrible period over the last 10, 12 innings, and he or she comes on to bat when the score is 73 for 5, we are all very jittery because the sports person hasn't done anything for the last 10, 12 innings, right? So what we say in cricketing terms is the batsman form is great, or the batsman is in great form, or the batsman is in poor form. And what we refer to form in cricket is what we call momentum in investing. So when we say momentum, we say the stock momentum has been strong or the stock momentum has been weak. What we mean by that is in the recent history, the stock has done extremely well or the stock has done poorly. That's all. That's what we mean. So that's like a very basic comparison between let's say cricket, giving you a cricketing analogy, and moment and investing, and especially with regards to momentum, but they both works the same way. A stock that's been doing well recently is expected to continue to keep up that performance, whereas a stock that has been doing poorly is also expected to underperform in the near horizon. That's how it works. And the question is, before we get to the question of why does it work, I want to highlight that momentum is not just specific to equity markets or even investing. We see it across our daily life. So look at the adoption of UPI. I mean, the adoption from 1819 and 1920 was staggering, but the scale is such that it doesn't look as big. But initially, UPI adoption started slowly and steadily. 1920, in the year FI 1920, it received a big push thanks to COVID. A lot of people went completely digital. And 2021, both years were driven by COVID and post effects of COVID, but also as price of cell phones kept getting cheaper, internet cost kept dropping, people kind of took to UPI and the numbers kind of grew substantially. The same thing with smartphone usage. Started out very slowly because iPhone was the only manufacturer of smartphones. Then came your Samsungs, HTCs, and the Chinese manufacturers. And then what you notice is that numbers exploded and then have kind of tapered off. So you see momentum in every facet of life, every aspect of our life. In momentum, it is very simple. The two things that are very common about momentum, as I said, first, momentum has only one pitch, or momentum has only one philosophy, which is that the market is right, the price is right, whatever the price is saying is right, whatever the market is saying is right. So if there is a trend, if the market is saying a certain style, a certain theme, a certain stock is doing well, market is right, we should latch on to that trend. So momentum is buying at a slightly higher price to sell even higher. It will not buy at the lows, it will not exit at the peak, but it will buy at highs and sell it at even higher price once the momentum or the pace of increase kind of goes tapers off, right? So that is momentum for you. The question is, why does it work? Is it just because 1,000 people are buying the same stock? Is that the only reason why it works? Is it just herd mentality? There is more to it. We in financial world call it underreaction. What I mean by underreaction, to put it simply, is digests information in stages. It doesn't digest information in one day. To give you an idea, I'll take a very simple example. We are in the midst of earning season. And so when a company delivers good numbers, obviously on the day of the earnings results, the stock goes up. But then it's not like the stock does nothing over the next 1 month or 2 months. It still keeps going up if that earnings improvement is sustainable. So effectively, the market doesn't incorporate all the information in one day. It incorporates slowly over days. So as it incorporates slowly over weeks and months, if you are able to identify the trend and latch on to it, you can make money on the upside as well. And the same thing in terms of avoiding stocks that are underperforming. So that is how typically momentum works. And it is not just restricted to India. Momentum is a global phenomenon, works across asset classes, interest rates, commodities, foreign exchange. US, the slide is about the maroon line is the US momentum index. The black line is the normal US index. You can see the momentum index has outperformed even in US consistently. Okay? But there are four things that I want to leave you with in terms of momentum. The first thing is momentum is your style timer. A lot of times people have questions: should I now invest in quality house, or should I invest in a value house, or should I invest in a growth house? Should I buy low volatility stocks? Should I buy high beta stocks? Where should I be in the market, right? Well, momentum does the timing for you. Momentum figures out what is working in the markets with a slight lag, because I said momentum only philosophy is market is right. So when it sees that a certain type of stock or a certain type of sector or style is working, momentum kind of latches onto it and then incorporates into your portfolio, and then from there on, it is part of that journey. So you can see here, I have returns of quality, momentum, and value index through time. What you notice is that momentum is consistently the second. Only 2 years of underperformance. So I've highlighted the worst performer in red. So there are only two red colors in here. So it has been the worst performer for only 2 years, whereas it has been a consistent second best performer. And because it has been the consistent second best performer, at the end of the period, it was doing better than quality and value. But more importantly, just notice in the years quality did well than value, momentum portfolio was more like quality. So value fell by 34%, quality fell by 10%. Now your momentum only fell by 16%. So it is more like quality. In a year like this year, 2024, value went up by 30%, quality went up by 17%. Notice your momentum has gone up by 27%, much closer to value. So basically, momentum reflects what is going on in the markets. If a certain trend, a certain style, a certain stock is working, momentum will latch onto it, and they'll keep changing as the underlying styles change. Momentum portfolio keeps changing. So you don't have to do the timing. You don't have to jump. Let momentum do the timing for you, right? And that is true of also large cap, mid cap, small cap. Typically, people ask me, have small caps run up? Should I switch from small caps to mid caps or small caps to large caps? What should I do? Well, let momentum do the timing for you. For instance, we've plotted the large, mid, and small cap composition of the portfolio from June of 2020 to June of 2024. This is for the Nifty 500 Momentum 50 Index. And what you notice is that in 2020, when large caps were doing really well, your 70% was invested in large cap and only 30% was invested in mid and small. Now, we all know by December of 2022, mid and small caps were doing extremely well, which is why now you look at the portfolio, so only 30% is in large caps and 70% is in mid and small caps. So now it has changed from from a portfolio that was predominantly large cap in June of 2020 to one that is predominantly mid cap or predominantly mid and small cap in December of 2022. So it can even do the style timing. It will do it with a lag, but it will do a lot more efficiently. Next, third point is people think that momentum has to underperform in down markets. We even casually make the statement that um, sorry, that the markets have corrected, and momentum has to and hence momentum has fallen. Actually, to measure momentum, we look at the trend of the stock from a period of 1 month to 12 months. Typically, what we see is how consistent the stock has been doing. If it has been doing consistently well over that period, it typically gets a higher momentum score. So if those trends are valid, even whether be it in a correcting market or in an increasing market, if the trends are valid, momentum will do well. For instance, in 2011, markets fell by 26%, your momentum portfolio only fell by 16%. There was a 10% outperformance. In 2020, despite all the COVID action and everything, momentum portfolio still outperformed your normal broader markets by 2.5%. So momentum has done consistently well across the cycle and has even done well during certain down markets. The only period it outperforms is if there is extreme sharp changes in market sentiment, like you had in 2008, which was a GFC after global financial crisis, when you had sharp change in sentiment where people thought everything is crashing in 2008 to suddenly everything is now great, which was the case in 2009. You see market fell by 57% and then went up by 91% in 2009. If you have such sharp moves, which happens very, very rarely in our markets, then momentum can underperform. But in most years, that is not the case, and momentum has done quite well across the entire cycle. So that is essentially momentum for you. I'm happy to take questions towards the end, as was mentioned previous about momentum. But a couple of things I'd like to highlight about Axis Momentum Fund and how we are going to manage this strategy. Firstly, in Axis Momentum Fund, our universe is 500 stocks, Nifty 500 stocks. From that, we will remove stocks that are illiquid. By illiquid, I mean stocks that don't trade as much, because we need to take positions in those stocks reasonably quickly and also need to exit it quickly. So if stocks are illiquid, we won't be able to take positions. So we will remove stocks that are reasonably illiquid, and we are left with around 410 stocks. For all those 410 stocks, we calculate a momentum score. Momentum score, as I mentioned previously, is calculated based on how consistent the returns are from a 1 month to a 12-month period and how good they are. So if the returns are positive, then it gets a good high momentum score. If the returns are negative during that period, then the stock gets a poor momentum score. And obviously, if a stock has good momentum score, we will give it a higher weight in the portfolio, and a stock that is got a lower momentum score will get a lower weight. But to decide the weight, we control for two things. We all know momentum is a slightly higher risk strategy, but it also gives you higher returns to compensate for that risk. But still, it's a slightly higher risk strategy. So to kind of control for it, we will ensure that we will allocate weights based on two things. One, how liquid is the stock, and second, what is the risk of the stock. If the liquidity is lower and the risk is higher, then the weight of the stock in the portfolio will be less, irrespective of how good that momentum score is. So typically, this is how the portfolio is rebalanced, and it's rebalanced every month. And then the whole process is systematic, rule based. My view of a stock or sector doesn't impact it. It's totally based on algorithm or a rule based process. So that is what momentum is for you. So in short, if I were to tell you, momentum is all about timing, which sector to be in, which cap space to be in, large cap, mid cap, or small cap, and which style to be in. If you have any doubts, then leave it to momentum will do the timing for you with a lag, but it will do a timing for you. Second, it is a slightly higher risk strategy, but it compensates with higher returns, and we will kind of try and control for that risk through our own risk measures. So those are the three main things about momentum as a whole. This is our model portfolio performance. As you can see, it has outperformed the benchmark by 6.6% on an annualized basis over the last 15 years. And these are gross performance, so you have to adjust for total expense ratio. But even if you do so, the returns are quite fantastic or quite good across the entire cycle. And it compares with any category of mutual funds. This return would hold in good will hold you in good shape. These returns, right? Lastly, as I talked about risk, the drawdowns are much lower. By drawdowns, I mean when the markets fall, the correction in the portfolio is much lower. For instance, over the last for the period that we've tested, markets have fallen by around 29% during COVID, but the portfolio only fell by 25%. So we managed to save 4% or beat the markets by 4% because of our risk control measures. So that's effectively momentum and Axis momentum for you. So just to summarize, four main reasons why you'd want to look at this strategy. First is that momentum gives you much better returns across the cycle. By cycle, I mean 3 to 5 years. Also, it gives you better adjusted performance. Slightly higher risk, but it compensates for that higher risk by better returns. Second, it is your style timer. If you don't know which cap space, whether to be in large, mid, or small, whether to be in growth or value, be in momentum, it will do the timing for you. Third, we will control for risk, as I mentioned, by controlling for certain parameters at a portfolio end so that the risk can be controlled. And lastly, this is a very new category. So a lot of you don't have exposure to this strategy or this style. So if you add to it, you are not doubling down on the same set of ideas. What I mean by that is, for instance, let's say you buy two large cap funds, then there is a lot of overlap between the two large cap funds. But if you add this to your existing portfolio of funds, because this is such a unique way of looking at investment, the commonality between what you hold and what you get from this fund will be much less. So that way you will be capturing something new. So those are the four reasons why I would want you to take a look at the Axis Momentum Fund. With that, I will stop and I'm happy to open it up to questions, be it on momentum or be it on the Axis Momentum Fund.
Thank you, sir. It was truly an insightful webinar, and I think, is it? Yeah.
Yeah, I can hear you.
And I
Yeah.
think we have understood a lot about the fund. We have a bunch of questions. We should we take those up?
Yes, please.
Okay. So the first question is from Mr. Shri V. He is asking, please let us know the advantage of investing through NFO.
See, this is a new strategy. We are launching a new strategy, and that is what an NFO is all about. This is a new category of funds. You'll get exposure to new category of funds. There are very limited options outside within momentum as a category as it stands today. So this gives you an opportunity to take exposure to this strategy. That is all NFO is about. We are launching this strategy in the market, and this gives you a chance to take exposure to this strategy.
Okay, we have one more question, which is what will be the time from Mr. Sarang Thakre. He is asking what will be the timeline for holding the stock, short term or mid term?
Okay. So momentum is a fast moving strategy. As market preference for different stocks and style change, we will also change. So this is more a mid-term kind of a holding period. My suggestion is you as an investor should hold this fund for the longer term, and we will take advantage of the trends in the market, but because momentum can switch very flexibly between all the styles. So you stay invested for longer term. Our holdings will be more medium term, where we will kind of switch between, as different styles and different trends evolve, we will kind of switch between the styles and the trends.
There is one more question from Mr. Saurabh Singh Chauhan. He is asking, is it a monthly or one-time thing?
Can you please clarify what do you mean by monthly or one-time thing?
I will pop up the question on your screen.
Okay.
Okay, he is asking, is it monthly or one time?
Sorry, because there can be couple of interpretations to this. One is he asking, should I go do a lump sum investment, or should I do a more like an SIP investment, or it could be about portfolio rebalancing, whether we are going to rebalance on a monthly basis or different frequency. I'm not sure what the question is. If Mr. Saurabh could clarify, that would be more helpful.
Okay. Next is, are mutual funds taxable? If yes, at what rate?
So mutual funds are taxable, but It is but it is a very tax efficient vehicle in the sense that you don't get taxed for every trade level. You only get, the investor only gets taxed based on for what period they have held the fund for. So if you held the fund for a period of 1 year or less, then you get taxed based on short-term capital gains tax rate, which is 20%. And if you've held it for a period for more than a year, then you get taxed based on long-term capital LTCG, or long-term capital gains tax rate, which is much lower.
I think we are towards the end of the question answer session. We don't have any more questions left here. We'd still wait it out for a minute or two if people have any more questions, uh, and then I think we can end it.
Got it.
Okay, I think Mr. Saurabh is back with his question. The
Mm.
question is popped up on your screen. I'll read it out for
Yeah.
you. He's
No, I
asking
got it.
about should we need to put one time? Yeah, you can take it over.
So yeah, so the question is, if should we put a lump sum amount or one time big amount, or if it can be done every month, some fixed amount. And actually, Mr. Saurabh, thanks for that question. That comes down to your views and personal portfolio and personal conditions. But effectively, if I were to look at it from my lens today, when I look at it, the markets have corrected fair bit since the peak in late September. So I, at a personal level, think, this is not a company view, this is a personal view. I, at personal level, think that markets getting attractive from a one-time perspective. Maybe the markets can still correct a few percentage here and there, but I think given the correction that has happened, I think I find the idea of a one time a bit more interesting. But you also have to consider your personal situation into account as well when you make that decision.
Absolutely. We have, I think, one last question after this from Mr. Silas Karji. He's asking what's the benchmark index of this fund?
The benchmark index for this fund is Nifty 500.
I think with that, we wrap up the question answer session. I think we are towards the end of it and the webinar as well. Sir, do you have any closing lines to conclude the webinar?
Thanks everybody for please logging in. Thanks for having me. As I said, please take a look at the NFO. Please consider it for one reason alone, which is that momentum is a great timer for you. If you have any doubts as to where to be, this is the fund where you need to be, and the fund will do the job of positioning you correctly, whether be it in large, mid, or small, or be it in any other category or style that is working, so that you don't have to do the difficult job of timing. That is what I think momentum at its core is. So I'd request everybody to look at it accordingly.
Thank you, sir. Thank you for your time. I think your insights truly shined throughout the webinar. It was truly insightful. Thank you for taking out the time and doing this with us. We really enjoyed it, and I hope the audience enjoyed it as much as we did. Thank you once again.
Thanks a lot. Thanks again. Thank you.
And thank you to all our audience who joined in. It was a great. I hope you have a great evening. Thank you.